The Great Recession can be defined as a sharp decline in economic activity during the late 2000s.
It's considered the largest downturn in the economy since the Great Depression.
The Great Recession occurred because lenders made poor decisions with who they gave loans to. They just assumed the stock market would keep climbing up because that's what it's always done, and if the people who were given loans didn't pay them back, it didn't matter because the lender could sell the house for profit anyway.
So between 2009 and 2011, I worked for a company in Highlands Ranch called Specialized Loan Servicing.
Okay.
SLS for short.
Right.
SLS was a loan servicer specifically targeting subprime loans. They managed about 13 billion subprime loans across the United States. So that was their area of specialty. I ran their asset management department between 2009 and 2011. So with that said, during that period of time, I ran what was called an REO department. REO stands for real estate owned, which is just a fancy name for foreclosed properties. When a property goes through the foreclosure process and a bank takes that property back, there's a department within a loan servicer. And in this case, we have a specialized department that takes over that property once it goes through the foreclosure process, and we market and dispose of that property through realtors we would have across the United States. So that's what I did between 2009 and 2011. Prior to having that position, I actually also built and ran a mortgage brokerage. And speaking as a mortgage broker, there was a large swing of the ability for individuals to qualify for a home loan prior to 2008. So between 2003 2004, a lot of changes happened in Washington that allowed individuals to qualify for a home loan. In our parents' generation, people say that typically it took 20% down to buy a home, and that was very true. And somewhere through that process, someone thought that let's start loosening lending guidelines to make it easier for a lot more individuals to qualify for a home. And there was sort of the beginning of what would have been the subprime marketplace. And that became a process where lenders and investors, and when you use the terminology investors, it generally means Wall Street, because lenders don't necessarily lend their own money. Investors on Wall Street provide the money to the banks or to the lenders then lend to the consumer. And so as they loosened those guidelines, what happened is that pretty soon you could buy a home with no money down, which was called a 100% loan. And the next thing you knew, you were able to buy a home without any qualification standards of providing full documentation to basically tell the bank that you can repay that loan, and that was called a stated income loan, which basically means that if you were a lender and I was a consumer, I could show you a credit score and I can tell you that I make X, and I can tell you that I have Y in my savings account, but never prove it to you.
The banks gave loans to subprime borrowers who bought houses they really could not afford. So they ended up not paying the banks back, causing a vicious cycle of bankruptcy from too many loans not being paid back and foreclosures of so many houses.
And so at some point in time, loans were really made based on the information that was shared by the consumer and a credit score. And if you had perfect credit, you got better interest rates. If you didn't have such perfect credit, you'd still get the loan, but you'd have substantially higher interest rates. Therein lies the whole dilemma of what the subprime crisis was all about. Because eventually that type of lending will catch up to a borrower, and when they can't necessarily make their payments, they start to default. But because the cost of money and the cost of loans was so easy to obtain, a lot of individuals not only acquired loans that really they shouldn't have never acquired in the first place, but B, they continually refinanced. Because back in the mid-2000s, appreciation for homes was still pretty solid. And so someone would have a home that one day was worth $200,000, next year was worth $230,000. They took out a $30,000 loan, took out more money, and did it over and over and over again. And so eventually that snowball effect of doing that over and over again, caught up to individuals, and that's how people started to slowly but surely lose their homes, because at the end of the day, they probably should have never qualified for that loan to begin with. And our politicians in Washington, had a great deal to do with why this happened. A lot of people blame it on the banks, but at the root cause, Congress and Senate, and back then, a Democratic president said it's okay for everyone to have a home, and we're going to loosen these standards. And so subsequently, the investors and the banks followed, but unfortunately, the banks ended up being the bad guys as opposed to Washington, which was probably the root cause of the entire thing to begin with. Maybe not everyone should be able to qualify for a home loan, because at the end of the day, if they can't make those payments, it hurts more than just them.
Yeah. Do you think that people bought homes that they couldn't necessarily afford, even though they could afford like a different home, but they just went, up than what they could have afforded, even though that they were still in that homeowner's area as far as income and savings and all of that, but they just, were slightly over here when they should have been more in this?
It's very true, and there goes the whole premise of what was called the stated loans. People in the industry also call them liar loans, because at the end of the day, maybe they made $80,000 a year, and that could have qualified them for a $200,000 home, but they told someone they made $120,000 a year. They took a mortgage for a $300,000 loan, and at the end of the day, they had no business trying to make a mortgage payment like that, and so that had a lot to do with it.
One of the major effects of the Great Recession was the amount of unemployment. In 2008 and 2009, the U.S. labor market lost 8.4 million jobs, or 6.1% of all payroll employment. Even 16 months after the official end of the recession, the economy still had 5.4% fewer jobs than it did before the recession even started.
Other effects of the Great Recession were the major decrease in family income, increase in poverty, and a loss in health insurance for both adults and children.
If you look at graphs of percent changes in non-farm payroll employment since the start of the recession, they show the huge difference between what it was like in the 90s or even 2001 versus 2007 to 2009. The percent change in employment rating dropped significantly in 2007 and continued to drop after the recession.
The next graph displays the amount of unemployed workers every time there is a job opening. There is a huge spike in the graph right between 2008 and 2009, demonstrating that the unemployment rating was steady until the time of the recession, where it skyrocketed.
The recession had some everlasting effects as well. The standard of living changed for a lot of people. Even those who managed to hold on to their jobs, more than 1 in 4 said the recession led to a major change in their standard of living.
How did it affect you in that, personally?
Yeah. Personally, it didn't affect us from the standpoint of being involved in, personal issues with our own mortgages and our own homes, but being in the real estate industry, starting as a mortgage broker, working for a loan servicer that specialized in subprime home loans. We also have a real estate company that specializes in selling only bank-owned properties. So for us, it's really been an opportunity to build careers and build businesses in a particular channel having to do with the foreclosure of homes and marketing those homes that maybe would not have been around if that crisis didn't occur. If that crisis didn't occur, I'd probably be doing something else. I'd probably still be a mortgage broker doing traditional loans as opposed to selling REO or bank foreclosed properties. So, we sort of, as a family, went with the flow and continue to work in that channel.